This is a bookbill summary of the book How to Make Money in Stocks by William J. O'Neill. Investment in stocks is a risky game. Unless you're spectacularly lucky, you can lose everything. What if the market goes down? What if you invest in a dud instead? William J. O'Neill presents 7 tried and tested methods to help you choose great companies, invest in them at the right time, and avoid unprofitable ones. Number 1. Learn stock chart patterns and one pattern precisely. Learn from history. The stock market's great winners and losers. Stocks that have climbed over a short period, those that have crashed, and those that have just plodded along unprofitably. This means that you can learn from the behaviour of past stocks and apply it to the present. The best way to do that is to read stock charts. Just as geologists use seismic data to study earthquakes, in investment, by learning to see patterns, one can assess current conditions or past practices to plan their next move. We can use the stock market data from the last 100 years to find patterns. That way, we know when to jump in or out of stock. So, what should one be looking for in stock charts? The answer is price patterns. There are hundreds of them, but one has proven to be fruitful over the decades. It's called cup of the handle. Be it stocks of Apple in the 2000s or sea containers in the 1970s, this trustworthy stock market pattern looks like its name. So, after rising for some time, a stock will often fall. As it falls, it sometimes makes a rounded, downward curve, becoming a steady, flat line. This is the base of the cup. This base is significant, because without a strong base of investors who believe in the stock, it could just collapse. But with this solid foundation, the stocks will rise properly when their fortunes change. It will form the other side of the cup as it climbs upwards. Just then, it dips back again, and it will form the handle. It's precisely at that point that you should buy in. More times than not, the stock will shoot upward. Number 2, increase in earnings. An essential quality is a good stock. Successful business comes with a growing stock price. When choosing stocks, you should look for those with significant earning increases. Consider the modern tech giant Google. Google started trading at $85 per share in 2004 and went to $700 in 2007. It showed a significant increase in earnings just before the stock shot up. Google showed earnings gains of 112% and 123% before its stock rocketed. However, there are pitfalls to this approach. One is getting dazzled by rumours of significant future earnings. For instance, during the big internet boom of the late 1990s, many speculative stocks didn't have concrete gains to show for themselves. Investors were drunk on the optimism of the moment, so they bought into them. Come the dot-com crash, these companies suffered enormous declines. But tech companies with severe earnings like Yahoo suffered much less. Hence, the lesson is to only invest in companies with growing earnings. When searching for these profitable companies, focus on the earnings per share or EPS number. This number is calculated by dividing a company's total after-tax profits by the number of shares issued. It would be best if you search for companies with big, consistent percentage increases in their EPS number. Of course, you shouldn't buy a stock on earnings growth alone. There are other important factors to consider. But the percentage increase in EPS is the most important factor when deciding to buy. Number 3. Innovative companies can make a good return, but learn when to invest in them. Great returns on the stock market and innovation go hand in hand. Innovation has led to remarkable stock price growth over the years. There's Northern Pacific, the first transcontinental railroad. From 1900 onward, its stock shot up 4,000% in only 2 years. Or take Cisco Systems, which created networking equipment that allowed companies to link up local area computer networks. Its stock climbed 75,000% in a year. Don't fret, there'll be others. Put in the hard work to spot them in time. But when is in time? A great innovative company will often continue to grow exponentially beyond what's predicted. So don't follow the traditional logic. Buy low, sell high. Instead, don't be afraid to buy when a stock is already high. However, there is a right time to buy stock. That is when it has consolidated its base and is about to break out. The cup with handle is a surefire sign of this. Number 4. Supply and demand, an essential factor in stock picking. The price of nearly everything is determined by supply and demand. The principle applies to the stock market too. Imagine that one company has issued 5 billion shares and another has 50 million. An enormous buying is required to produce a stock rally in one with 5 billion shares. But the smaller stock could shoot up much more quickly. The supply for the small stock is much less, so price movements would be dramatic. But just as it could fly upward very quickly, a so-called small cap stock could crash just as dramatically. While the rewards could be more spectacular, the downside is sometimes much larger. A company with many more issued shares is less risky because a great deal of selling is needed before the price moves. Hence the law dictates that a small company can yield more explosive results, and a big company might be a more reliable investment. Here comes another factor. Who owns these shares matters. In big and small companies alike, it's a good sign if top management owns a significant percentage of company shares. If management owns at least 1 to 3% of a big business and more in small companies, the business will generally be a big investment. Another factor to keep in mind is companies buying back their own stock. This is a good sign. It suggests that the company believes improved earnings are on the horizon and that their stock could soon be in high demand. Number 5. Buy industry leaders. We have our favourite companies. Here, we tend to invest in companies like Coca-Cola or Nike with well-loved products and a lasting brand. However, in a bull market, dynamic new leaders can sometimes leave old favourites like these in the dust. As a rule, you should buy the leading companies in their group. A leading company is not necessarily the largest or the most recognised brand name. They have the best quarterly and annual earnings growth, the strongest sales growth, the widest profit margins, and the highest return on equity. They will have a unique and innovative product that is driving these results. Avoid the second best or the copycat company. The leader will nearly always consistently outperform these. It's always the real innovators and entrepreneurs that drive the market. These are the companies in which you should look to invest. Number 6. You should look for stocks with institutional sponsorship. Rather than purchase individual shares, some investors put their money into funds. A fund is a whole assortment of different stocks bundled into one investment. They're called mutual funds. These funds are provided by big institutions and run by financial experts who handpick which stocks to include. As an individual stock investor, it's worth checking which stocks these experts have picked. These giant institutions make up the bulk of stock buying in the market, which drives the market, pushing stock prices higher or lower. With this in mind, it's worth paying attention to their actions. If you own shares that the big institutions buy, you will see the stocks rise in your portfolio. Specifically, pay attention to what the best performing funds are doing. These funds generate the most significant annual returns and are run by the most insightful investors. Institutional investing also matters in general, whether or not it's from top performing funds. If any funds buy into a stock, it will rise in value. Along with analysing the activity of these institutions, it's worth knowing about their stock picking philosophy. You can learn from the best by looking at their prospectus, which you can download or request directly from the firm. The prospectus will tell you which technique each fund employs and the kinds of stock they've purchased. However, it's worth noting that some stocks can become over-owned by big institutions. Some stocks are bought automatically, even when they're not in great health. The lesson here is to learn from the best and do your homework. Nothing beats your due diligence. Number 7. Keep a close eye on the general market direction. Individual stocks only matter up to a point. If the market goes down, you'll lose money. Just think back to the crash of 2008. For the most part, it didn't matter how good your stock picking was. If you didn't sell in time, you lost your money. The truth is that 3 out of 4 stocks will lose value if the general market winds downward. What exactly is the general market? It's an overview of the major stock indices. You can monitor these online. To judge the general mood of the market, you should check if there has been significant buying or selling going on. In a resource like Investors Business Daily, you'll see an accumulation or distribution rating for a given index, like the Nasdaq. It tells you if investors are buying or selling in a particular index. That will tell you if they have confidence in the market or fear a dip. Keeping a close eye on these indices is essential, as a change can happen over a few weeks. If you fail to pay attention, you could be left open-mouthed as a big crash wipes out your returns. For instance, if you notice that stocks keep opening high and closing low, the market could enter a bear market, where prices fall. Conversely, if you see that stocks open weak and close firmly, it could be the first sign of a bull market. Without daily scrutiny of the general market, you'd never know this was happening. Don't listen to too many financial analysts or investors' newsletters on the state of the market. For the most part, these are expensive distractions. Experts whose opinions contradict one another can confuse rather than clarify things for you. The best strategy is to observe the market itself. What's your most important key takeaway? Please comment down below and share the video if you like it. Check out these other 2 videos. Thank you, and until next time.